Let's turn back, though, to the markets. My next guest just switched his view from neutral to bullish in the markets. He's here to tell us why. He's back with us, Michael Rourke, the chief market strategist at institutional brokerage house BTIG. And Mike, earlier, Sarah Eisen was talking about how these bears, right, Mark Faber and David Rosenberg have dug in their heels. They believe the worst is yet to come for the markets. And you're here sitting there saying, look, we're going to get more bullish.
Yeah, I mean, what's interesting, what's going on here, I think this is an interesting opportunity in the fact that, you know, we've had earnings recover and they continue to recover. We've had the economy in recovery, and you've had this major, what I've termed...
Is the economy in recovery, Mike? I mean, is the economy in recovery?
It's a lot better than it was a year ago, and I think it's hard to dispute that. So while we've seen economic data soften, we're still seeing, you know, expansionary numbers and things like the ISM. So yes, it's softer, but what I'd say is this market's priced for a Bill Gross new normal type recovery or a soft environment. And what I'd like to know is this correction we've had over the past several months has been very severe, especially relative to history ex-2008. I've termed it an echo panic, and I think that we've seen sentiment wash out, so we're in a good place here.
So you think it's been something like 17% peak to trough, right, for this correction, and that equals to the pricing in of this new normal in the economy?
Well, I mean, that's part of it. We're seeing the S&P 500 trade at very cheap multiples. In addition, we know major corporations have tons of cash at hand, so the multiple's even cheaper when you think about all the cash they have. But you know what happened here is.
But it's cheaper. It's cheaper unless you think there's going to be a double dip.
Well, but even if there's, I mean, the question is, if there's a double dip, how much do you expect earnings to taper off here or fall off here? Right. And we're not seeing earnings weakness by any way, shape, or form to that level. So, I mean, that's the question. If you expect a double dip, where do you expect earnings to go? Right now, we're not seeing that, and the data is not pointing that direction. So, you know, yeah it's always a possibility, but we're not heading there yet.
But Mike, some might say though that what you're seeing in the second quarter so far is peak earnings. This is peak earnings. It's all going to go down from here.
I mean, they can say that. I think they're dead wrong. I mean, we have had an incredible, unsettling recession in this economy, and we're just in the early stages of recovery. I mean, all along, ever since 2008, we said it would be a jobless recovery, it would be a slow recovery, and that's what we're getting. And the equity market's trading like it is. And the fact is, this high risk premium in equities, which equates these low multiples, is pricing that in. And where the real risk is for investors is to the upside if we actually see economic data to start gain any momentum in the second half of the year.